If you are currently receiving old age security or the guaranteed income supplement, there is critical information you need to understand before the summer of 2025 arrives. Your monthly payment could potentially decrease, and this has absolutely nothing to do with any new legislation, unexpected budget reductions, or secretive government decisions. The explanation lies entirely within your 2024 income tax return. At this very moment, Service Canada is utilizing your 2024 reported income to calculate what you will receive from July 2025 through June 2026. This means whatever you earned, withdrew from registered accounts, or reported on your tax return last year could directly influence the amount deposited into your bank account beginning this summer. A significant number of Canadian seniors remain unaware of how this calculation system operates until they notice a smaller deposit appearing in their accounts. By that point, the reduction often feels sudden and deeply confusing. The encouraging news is that this entire process is entirely predictable, and if you take the time to understand the governing rules, you can anticipate changes well in advance and take appropriate action when necessary. Canadian seniors should first understand how old age security functions within this framework. Old age security represents a monthly pension distributed to most Canadians aged 65 and older who satisfy specific residency requirements established by the federal government. The amount an individual receives depends primarily on the duration of their residence in Canada after reaching 18 years of age, and the benefit amount is adjusted quarterly according to inflation rates. However, old age security is also subject to what officials formally call the Old Age Security Recovery Tax, which many Canadians commonly refer to as the clawback. This particular provision applies specifically to higher income seniors across the country. When your net income exceeds a designated annual threshold established by the federal government, you become obligated to repay a portion of your old age security through the taxation system. The government calculates this repayment at a rate of 15% on every dollar earned above the established threshold. For the payment period spanning from July 2025 through June 2026, Service Canada examines your net income from your 2024 tax return to determine benefit amounts. The crucial figure is your net income, which appears on line 23600 of your 2024 Notice of Assessment issued by the Canada Revenue Agency. If that net income figure exceeds the annual recovery threshold established for 2024, your old age security payments will face reduction beginning in July 2025. It bears emphasizing that this calculation is not based on your current income during 2025. The determination relies strictly upon what you reported for the 2024 tax year. Understanding the practical application of these rules proves essential for proper financial planning. Consider a scenario where the recovery threshold sits at approximately $90,000 for the 2024 tax year. If your net income fell below that figure, you will not encounter any old age security recovery for the July 2025 through June 2026 period. However, if your income exceeded that threshold, your old age security payments will experience reduction. To illustrate further, if your net income exceeded the threshold by $10,000, you would repay 15% of that amount, equaling $1,500 in total. That $1,500 amount would be recovered through reduced monthly old age security payments distributed across the following 12 months. For certain seniors, this reduction may prove relatively modest and manageable within their overall budget. For others, particularly those reporting significantly higher income levels, the clawback can potentially eliminate their entire old age security benefit. This outcome tends to affect seniors with substantial pension income, large registered retirement income fund withdrawals, significant rental income, considerable investment returns, or capital gains resulting from property sales or investment transactions. The Guaranteed Income Supplement operates under fundamentally different principles than old age security. This benefit is specifically designed for low-income seniors who already qualify for and receive old age security payments. The Guaranteed Income Supplement is entirely non-taxable and undergoes income testing far more aggressively than old age security. Unlike the 15% recovery rate governing old age security, the Guaranteed Income Supplement faces reduction by 50 cents for nearly every dollar of additional income you receive, excluding old age security itself. Stated plainly, if you receive $1,000 in additional annual income beyond your old age security payment, your Guaranteed Income Supplement can decrease by approximately $500. Mirroring the old age security calculation, your guaranteed income supplement entitlement from July 2025 through June 2026 derives from your 2024 tax return. This means Service Canada is currently examining your 2024 income figures to determine your monthly guaranteed income supplement amount beginning in July 2025. If your income increased during 2024 compared to 2023, your guaranteed income supplement may decrease accordingly. Conversely, if your income decreased, your guaranteed income supplement could potentially increase. However, if your income experienced a significant spike during 2024 due to a one-time financial event, you may observe a noticeable reduction in your monthly guaranteed income supplement payment arriving this summer. This particular situation catches many Canadian seniors completely unprepared. Perhaps you withdrew additional funds from your registered retirement savings plan during 2024 before converting it to a registered retirement income fund. Perhaps you sold property and realized a taxable capital gain. Perhaps you assisted a family member by co-signing a financial arrangement and subsequently received repayment including interest. Perhaps you accepted part-time employment or received retroactive pension payments covering previous periods. Every one of these scenarios counts as income for taxation purposes, and most contribute directly to your guaranteed income supplement calculation. Consider a hypothetical situation involving a single senior receiving full old age security along with a substantial guaranteed income supplement amount throughout 2024. During that year, she decides to withdraw $15,000 from her registered retirement savings plan to finance necessary home repairs. That withdrawal is fully taxable under Canadian law and increases her net income accordingly. Consequently, when Service Canada reviews her 2024 tax return, officials observe higher income than previous years. Beginning in July 2025, her guaranteed income supplement undergoes recalculation in a downward direction because of that elevated reported income. The resulting reduction may persist for a full 12 months, despite the withdrawal representing an entirely one-time occurrence. Identical principles apply to registered retirement income fund withdrawals that many seniors must make annually. Once you convert your registered retirement savings plan to a registered retirement income fund, federal regulations require you to withdraw a minimum amount each calendar year. That mandatory minimum increases as you advance in age according to prescribed tables. These withdrawals are fully taxable and contribute directly toward your net income calculation. If your mandatory registered retirement income fund withdrawal increased significantly during 2024 due to advancing age or substantial account growth, that additional amount could elevate your income sufficiently to reduce your guaranteed income supplement or trigger partial old age security recovery. The Canada Pension Plan represents another significant factor in these benefit calculations. Canada Pension Plan payments are fully taxable and count toward your income for both old age security recovery and guaranteed income supplement determination. Throughout recent years, the Canada Pension Plan has undergone gradual enhancement, and payments have also received indexing adjustments to account for inflation. If your Canada Pension Plan amount increased during 2024 due to inflation indexing or because you commenced receiving benefits during that year, that elevated income could reduce your guaranteed income supplement entitlement. For guaranteed income supplement recipients who maintain employment, the federal government provides an employment income exemption offering some relief. The first $5,000 of employment income receives complete exemption from the guaranteed income supplement calculation. Additionally, a portion of employment income falling between $5,000 and $15,000 receives partial exemption. However, this exemption applies exclusively to employment or self-employment income. The exemption does not extend to Canada Pension Plan benefits, pension income, registered retirement savings plan withdrawals, registered retirement income fund withdrawals, rental income, or investment returns. Therefore, income derived from savings and investment portfolios can reduce your guaranteed income supplement more sharply than income earned from part-time employment within the exemption parameters. Understanding the precise timing of these benefit adjustments proves crucial for effective financial planning. The federal government operates old age security and guaranteed income supplement on a July through June payment cycle directly connected to the previous calendar year's income. Each July, Service Canada adjusts your payments based on your most recently assessed tax return information. For the period spanning July 2025 through June 2026, officials utilize your 2024 tax information. When July 2026 arrives, they will transition to using your 2025 tax return for subsequent calculations. This timing structure means that even if your income has already declined substantially during 2025, your payments may continue reflecting higher 2024 income levels unless you initiate specific action. Fortunately, a solution exists if your income has experienced significant decline. You possess the option to request a reassessment based on an estimate of your current calendar year income. This process involves completing a Statement of Estimated Income form and submitting it directly to Service Canada for review. If officials approve your request, your benefits can undergo recalculation based on your lower projected 2025 income rather than your elevated 2024 income. This approach proves especially beneficial if you retired during 2025, ceased working entirely, or experienced a one-time income event during 2024 that will not recur in subsequent years. Examining a practical scenario helps illustrate these principles clearly. Consider a married couple where both spouses receive old age security payments and one spouse receives partial guaranteed income supplement benefits. During 2024, they completed the sale of a rental property and reported a resulting capital gain on their tax return. Their combined net income increased significantly for that particular tax year. Beginning in July 2025, the spouse receiving guaranteed income supplement observes a reduction because the couple's combined income now exceeds applicable thresholds. However, with the rental property now sold, their ongoing income during 2025 is substantially lower. In this particular situation, filing an estimated income statement could potentially restore a portion of their guaranteed income supplement benefits sooner rather than requiring them to wait until July 2026 for automatic adjustment. Reviewing your 2024 Notice of Assessment thoroughly remains absolutely critical for anticipating these changes. Locate line 23600, which displays your net income for the tax year. Compare that figure against the applicable Old Age Security Recovery threshold and Guaranteed Income Supplement income limits corresponding to your marital status. If your income approaches the threshold or exceeds it, prepare appropriately for the possibility of reduced payments beginning in July. If you remain uncertain about interpreting the relevant figures, consider consulting with a qualified tax professional or contacting Service Canada directly for personalized guidance. Some Canadian seniors inquire whether strategically delaying Canada Pension Plan or old age security benefits can assist in managing income thresholds effectively. Delaying old age security increases your monthly payment by 0.6% for each month you postpone beyond age 65, continuing until age 70. Delaying Canada Pension Plan increases your payment by 0.7% monthly after age 65, also continuing until age 70. While these increases prove beneficial in numerous circumstances, they simultaneously raise your taxable income once benefits commence. For guaranteed income supplement recipients specifically, a higher Canada Pension Plan payment received later could reduce guaranteed income supplement benefits more substantially. Each individual situation differs considerably, making careful personalized planning absolutely essential. Strategic management of registered retirement savings plan and registered retirement income fund withdrawals represents another valuable planning consideration. Rather than withdrawing a substantial lump sum within a single calendar year, distributing withdrawals across multiple years may substantially reduce negative impacts on guaranteed income supplement entitlement and old age security recovery calculations. Similarly, timing asset sales or capital gain realizations to occur during lower income years may help minimize clawback amounts significantly. Provincial benefits can also experience effects from changing income levels. Numerous provinces offer supplementary benefits directly connected to guaranteed income supplement eligibility or specific income thresholds. If your guaranteed income supplement faces reduction or elimination due to elevated income, you may simultaneously lose access to certain provincial top-up programs. This interconnection provides another compelling reason why understanding your complete income picture remains so critically important. The essential message is that July 2025 payment amounts are not arbitrary or random. They are entirely formula-driven and based directly upon your 2024 tax return information. If your income increased during 2024, your old age security may undergo partial recovery, and your guaranteed income supplement may face reduction. If your income decreased, you may qualify for enhanced benefits, particularly if you submit an application for reassessment based on estimated current year income. Waiting until you observe a smaller deposit before initiating inquiries represents an inadvisable approach. Review your tax return documentation now, while time remains for planning. Understand precisely which income sources contributed to your net income calculation. Identify whether any one-time events occurred that elevated your income temporarily. If you anticipate reduction and your current income has declined, consider submitting appropriate forms promptly to Service Canada. Service Canada can provide information regarding your specific circumstances, but officials rely entirely upon information provided by the Canada Revenue Agency. Filing your tax return punctually every calendar year remains essential, even when your income is relatively low. Guaranteed income supplement benefits in particular can experience interruption if tax returns remain unfiled. For many Canadian seniors, old age security and guaranteed income supplement constitute the foundation of retirement income security. Even modest reductions can significantly affect monthly budgeting and financial stability. By reviewing your 2024 income thoroughly and understanding its direct connection to July 2025 payments, you position yourself for control rather than surprise. The system may initially appear complex, but it follows clear and consistent rules. Income reported for 2024 determines your old age security recovery and guaranteed income supplement entitlement for the period spanning July 2025 through June 2026. Elevated income can reduce benefits accordingly. Lower income can enhance them correspondingly. One-time income spikes can produce temporary consequences affecting an entire benefit year. And when your income situation changes substantially, mechanisms exist to request official reconsideration of your benefit amounts. Dedicate time now to examining your notice of assessment carefully. Compare your income against relevant thresholds established for your circumstances. Plan comprehensively for July. When necessary, seek guidance from a knowledgeable professional familiar with these benefit programs. By acting early and decisively, you can avoid uncertainty entirely and ensure you receive the full benefits to which you are legally entitled under Canadian law.